Okay, here we go with the Chapter 8 self-test. What type of receivable is evidenced by a formal instrument and normally requires the payment of interest? So formal is the key word here, and payment of interest, I guess, is another one. So this would be a note receivable as opposed to an account receivable where it's less formal, usually because we bought stuff and they gave us time to pay. So note receivable. Number 2, which of the following should be classified as an other receivable? And let's see, trade receivables, interest receivable, accounts receivable, or notes receivable. And that one is interest receivable because for most of us, we're not in the business of collecting interest as part of our operations. And so any collection of interest is an other revenue. And so interest receivable is going to be an other receivable. Number 3, what type of receivables result from sales transactions? That would be a trade receivable. Trade just means the normal course of doing business. So anytime I have a receivable that comes about because of that normal doing business sales, that's a trade receivable. Number 4, on June 15th, Kersey Company sold merchandise on account to E&G Company for $1,000, terms 210, net 30. On June 30th, E&G Company returns merchandise worth $300 to Kersey Company. On June 24th, payment is received from E&G Company for the balance due. What is the amount of cash received? So I think what they're trying to get us with here is to recognize that, first of all, there's a discount if they pay within 10 days. And they pay within 5, as a matter of fact. And then secondly, I'm sorry, they don't pay within 5, they return some merchandise within 5, and then they pay within, let's see, 9 days. So they still get the discount. So they want us to recognize that, first of all, there's a discount, and secondly, that there's a return, and then thirdly, that the return amount is not part of the discount. So if they've paid $1,000 and then they had a $300 return, that means the amount outstanding was $700, and when they take that 2% discount, it's going to be based on the $700. There's 2 ways of doing that. You can multiply the amount owed by 2% or 0.02, and that will give you the amount of the discount. And you then subtract that from the total amount owed, which will give you the total amount they have to pay. Or you can multiply the total amount owed by, in this case, 98%, and that will just kind of directly tell me that they had to pay $686. If I took 700, multiplied it by 2, I get $14. That's the amount of the discount. Then I can take 700, subtract 14, be $686. Or I can just say if there's a 2% discount, I have to pay 98% of the total. So that's still going to be $686. 2 ways to go about finding it. Number 5, when is a receivable recorded by a service organization? So you record the receivable at the time you earn the revenue. And you earn the revenue, if you're a service corporation, by providing services. So when the service is provided on account, that's when the receivable will be recorded. 6, receivables are reported on the balance sheet at the cash amount owed by customers. And that's false. They're actually reported on their balance sheet at the net realizable value, which is the amount owed by customers less any allowance for doubtful accounts, or less any amount we think is likely won't get paid to us. That's just because on the balance sheet we want to be conservative, and we want to recognize if we don't think we're going to collect all that money, we want to recognize that that it's not all an asset to us then. Number 7, under the allowance method, the write-off of an account receivable leaves the net realizable value of the receivables unchanged. And that's true. If you remember, the way this works is that we have the account receivable less any amount, which is the allowance for doubtful accounts that we think won't be collected. If we finally decide that we really aren't going to collect something, then we write it off. And the way we do that is by both reducing the account receivable or crediting the account receivable account and reducing the allowance for doubtful accounts or debiting that account, which in essence leaves the total net realizable value the same because we subtracted the same amount from our account receivable and from the allowance for doubtful accounts. So that is true. Number 8, allowance for doubtful accounts is closed at the end of the fiscal year, and that is false. Instead, what we do is we adjust it to the new amount. Usually at the end of each fiscal year, we make an estimate for the next year as the amount we think will be uncollectible and make an adjustment to bring the account up to that. So it's not closed. 9, the direct write-off method violates the expense recognition principle. That's true because we write the things off as an expense in a period different from when we earned the revenue, and that will throw us off. Number 10, at what value are accounts receivable reported on the balance sheet? We're going to call it the net realizable value. Number 11, Ritronics uses the percentage of receivables method for estimating bad debt expense. The accounts receivable balance is $100,000 at year end, and the total credit sales were $800,000. Management estimates that 4% of receivables will be uncollectible. What adjusting entry will be recorded in the allowance for doubtful accounts if the allowance for doubtful accounts has a credit balance of $800 before the adjustment? All right, so what we have to do then is we have to say accounts receivable, they use the percentage of receivables method. So if accounts receivable has a $100,000 balance, and we think that 4% won't be collectible, that's $4,000 that won't be collectible. There's already a balance of $800 in the allowance for doubtful accounts, and that should be a credit balance because the allowance for doubtful accounts is a contra asset. It offsets the asset accounts receivable. So we need to take an account with an $800 credit balance and bring that balance up to $4,000. We would do that by crediting the account an additional $3,200. So the allowance for doubtful accounts has to be credited $3,200, and the bad debts expense will be debited $3,200. Again, this lets us take the expense this year, or during the same year where the revenue was earned. So now we're offsetting that revenue with the expense of not being able to collect it, and puts the rest in an allowance that we can offset any actual write-offs in the next year with. All right, number 12. When an uncollectible account is recovered after it has been written off, which of the following accounts will be credited in the process? So remember when we write it off that we credit the accounts receivable to take it off of the accounts receivable, and we debit the allowance for doubtful accounts. That's the process of writing something off. So after we write it off, somebody shows up and says, hey, I have that money I owe you. Now we have to reverse that, and we're going to debit the accounts receivable, and then we will credit the allowance for doubtful accounts. Then, once we've done that, so in essence we've reversed the write-off, then we will debit cash and we will credit accounts receivable. So we reverse the write-off and then show that the cash went up and the accounts receivable went down. So now let's get back to their question. When an uncollectible account is recovered after it has been written off, which of the following accounts will be credited in the process? So in the process we said we would credit the allowance and then we would credit accounts receivable. So the allowance for doubtful accounts and accounts receivable. Seems like somewhere in there we would have to deal with the bad debt expense too, wouldn't we? So that would be an interesting one to see how it turns out when we grade it. And if it is, we'll talk about that. Number 13, which of the following statements is true? Bad debts expense and allowance for doubtful accounts are both nominal accounts and are closed at the end of the fiscal period. Not true, because the allowance for doubtful accounts is a permanent account that allows things to transfer over to the next period. B, bad debt expense and allowance for doubtful accounts are both real accounts. No, because the bad debt expense is a nominal account that we close out at the end of the period. C, bad debt expense is a nominal account and is closed at the end of the fiscal period, while allowance for doubtful accounts is a real account and remains open at the end of the fiscal period. That's true. And then bad debt, and then that's the reverse. That one's false. Number 14, the Obama company has identified that Bill Clinton's receivable account of $100 is uncollectible. Wow, that's not nice. I think Bill Clinton probably pays his bills. I don't know, though. You know, you can say bad things about people, but I think he pays his bills. Anyway, let's see. What is the journal entry needed to write off the account under the allowance method? So if we don't think that Bill Clinton's going to be able to pay his bill, then what we're going to do is we're going to get rid of the account receivable. That'll be a credit. And we're going to get rid of the allowance for doubtful accounts for that account, which will be the debit. So we'll debit allowance for doubtful accounts, $100, and we will credit accounts receivable, $100. 15, net credit sales for the month are $4 million for Mark's Clothiers. His accounts receivable balance is $160,000. The allowance is calculated as 7.5% of the receivables balance using the percentage of receivables basis. The allowance for doubtful accounts has a credit balance of $5,000 before the adjustment. How much is the balance, the allowance of the allowance account after adjustment? All right. So let's see. Again, the net credit sales for the month are $400,000. That's irrelevant. Accounts receivable balance is $160,000, and the allowance is 7.5% of receivables. So we'll say 160,000 times 7.5% should be $12,000. The allowance for doubtful accounts has a credit balance of $5,000 before adjustment. How much is the balance of the allowance account after adjustment? So remember, if we're saying that it should be $12,000, then we would make an adjustment to make the account equal to $12,000. So they're kind of being tricky with this question. The answer is $12,000. If they're asking how much the adjustment should be, then we would say, well, if there's $5,000, we have to add another 7 to make it 12 total. But they're asking how much is the balance of the account after the adjustment, and we're going to bring it up to $12,000 based on 7.5% of the $160,000 receivable. All right, number 16. During 2014, Patterson Wholesale Company had net credit sales of $750,000. January 1st, 2014, the allowance for doubtful accounts had a credit balance of $18,000. During 2014, $30,000 of uncollectible accounts receivable were written off. Past experience indicates that the allowance should be 10% of the balance in receivables. If the accounts receivable balance at December 31st was $200,000, what is the required adjustment for the allowance for doubtful accounts? Okay. So this one, I'm going to bring up my little Excel spreadsheet here and use it for scratch paper, because there's a lot of things going on in this problem. So I'm going to do a T account here for the allowance for doubtful accounts. I'm just going to call it ADC. If you live in Arizona, that could also mean the Arizona Department of Corrections, but for us today it'll be allowance for doubtful accounts. All right, so it had a credit balance of $18,000. Then during 2014, $30,000 of uncollectible accounts receivable were written off. When we do that, then we do a debit to the allowance for doubtful accounts, and we credit the the accounts receivable. Past experience indicates the allowance should be 10% of the balance in receivables, and the accounts receivable balance was $200,000. So we would say 200,000 times 0.1, which we all know is 20,000. So this account should have a balance then. When we're all said and done, we want it to have a balance of $20,000. So if we started with 18,000 on the credit side, then we debited 30,000 during the year, and we want to end up with a credit balance of 20,000, then the question is, how much should the adjusting entry be? So should be then, I'm just doing math in my head here, 32,000. Let's see if that all adds up. That should give us 50,000 on the credit side, 30,000 on the debit side, which gives us a balance of 20,000. Really, we just had to say, if I had 18 and I took away 30, which would give me negative 12, what would I add to it to get up to 20, which would be 32. So 32,000 is the amount of our adjustment for that year. Number 17, if a company uses the following method for uncollectible accounts, the allowance method for uncollectible accounts, then the entry to record $800 of estimated uncollectible is, so again, we would do, if we think we're not going to be able to collect $800 in the next year, we're going to do a bad debt expense of $800 and allowance for doubtful accounts of $800. Which one of the following is part of the transaction that is recorded when an account is written off under the allowance method? All right, so I've already talked through this. I'm going to talk through it one more time. When we write off a debt, we're going to reduce the accounts receivable, and we're going to reduce the allowance for doubtful accounts. So we reduce the allowance for doubtful accounts by debiting it. So we will debit allowance for doubtful accounts, and we will reduce the accounts receivable by crediting it. So we will credit accounts receivable. So allowance for doubtful accounts is debited, and the accounts receivable is credited, which isn't on there. The Ryan Leaf Company uses the percentage of receivables method for recording bad debts expense. The accounts receivable balance is $60,000 at year end, and total credit sales were $2,300,000 for the year. Management estimates that 3% of receivables will be uncollectible. What adjusting entry should be made in the allowance for doubtful accounts if the allowance for doubtful accounts has a credit balance of $200 before the adjustment? All right. So first thing we need to do is figure out if they have accounts receivable of $60,000, and we believe that 3% is not collectible. That means the balance of our allowance for doubtful accounts should be $1,800. That's a credit balance. We already have a $200 credit balance, so we need to do another $1,600 credit to the account. So we get to the end of the year, we make an adjustment where we claim a bad debt expense of $1,600 and allowance for doubtful accounts of $1,600. Number 20, an analysis and aging of the accounts receivable of Raja Company at December 31st reveals the following data. Accounts receivable 800, allowance for doubtful accounts 12,000, amount expected to become uncollectible 65,000. How much is the cash or net realizable value of the accounts receivable at December 31st after the adjustment? All right, so we'll figure out the amount of the adjustment first. So they believe that $65,000 is going to become uncollectible. They already have a balance of $12,000 in the account, so they need to do an adjustment of, what would that be? $53,000. to bring it up to 65,000. So after the adjustment, the amount that we expect to be uncollectible will be 65,000. So our balance sheet will look like this: accounts receivable, 800,000 less allowance for doubtful accounts, of 65,000. We'll give them a net realizable value of 800,000 minus 650 of $735,000. All right, 21. Short-term notes receivable are reported at their cash net realizable value. That's true. Notes receivable are reported at in the current asset section of the balance sheet at the net realizable value. There's not usually a market value on notes receivable. You don't factor in the interest or things like that. So we always record those notes at what we believe we're going to actually receive from them, which is the net realizable value. All right, number 23, which of the following is not one of the 5 basic issues in accounting for notes receivable? Recognizing, realizing, valuing, disposing. So apparently we have 5. I didn't know that those were the 5 things, but I bet you that's how it's written in the book. So let's see, let me think through it, and we'll say recognizing notes receivable. In other words, how do we record them in the book? Realizing, that's not going to be in the book. Valuing is disposing, so it's going to be realizing notes receivable. All right, number 24, a 90-day promissory note is issued September 15th. What is the note's maturity date? So this is that issue of figuring it out. We have to say, okay, if I have a daily interest rate, then what am I going to include in my count? Because it can be a little bit confusing. So here's how I would go about doing this. Let me bring up my little scratch paper again here. I would say the term of the note, it's 90 days in this case. All right. Then I'm going to figure out how many days there are in each month. It says this was issued September 15th, but I am not going to include the issue date. Okay, that's how you do this. So you omit the issue date. So I'm going to say if it was issued September 15th, we're going to say September 16th through September 30th. That's going to be 15 days. And then we have October 1st through the 31st. Which is 31 days. And this is kind of a pain, but I don't know a better way. November 1st through the 30th, which will be 30 days. Oops, I didn't type days, 30 days. And now we'll see that we have to figure out September. In essence, we just say, look, if we had 90 days total, and we've used up 15 and then 31 and 30, which is 61, 76 days, then we have 14 days remaining on the 19, and that would be the due date, September 14th. You can just really, the hardest part is remembering not to include the initial day or the issue day. And then really all you do is you take the term in days and then you say there's 15 days from September 16th to 30th. There's 31 days from October 1st to 31st, 30 days from November 1st to 30th. Subtract those from the 90 and what you get left over is 14 days. And that's when it will be due. Oh, not September, December 14th. Those can be confusing sometimes. Which one of these statements about promissory notes is incorrect? The party making the promise to pay is called the maker. So here's another one where they're kind of dealing with vocabulary. The party to whom payment is to be made is called the payee. The promissory note, or a promissory note, is a negotiable instrument. A promissory note is more liquid than account receivable. Which one of these is incorrect? And so the one that stands out to me as obviously incorrect is the fact that it says they're non-negotiable. Promissory notes are negotiable, meaning you could transfer them to someone else. You could you could endorse it just like you would the back of a check and give it to someone else, and now they're the owner of the account receivable. I'm sorry, the note receivable. So that's C. 26, Michael Company accepts $4,000, 3% or 3-month, 12% promissory note and settlement of an account with the Tanny Company. The entry to record the transaction is, so we're going to have a note receivable of $4,000, and this is a settlement of an account. So the note receivable is going to pay off the account receivable. So that is B. Remember, we don't figure in interest or anything into the initial recording of it. We just record the note receivable increasing, that's the debit, and the account receivable decreasing, which is the credit. 27, at what amount is a short-term note receivable recorded on the issue date? And the answer is the face value, or the amount that we're borrowing or loaning. 28, how much accrued interest should be reported on the payee's December 31st balance sheet on a $5,000, 8%, 9-month note payable receivable issued June 1st? Okay, so the easiest way to figure this out, for me anyway, is to figure out what the monthly interest is. So you take the face amount, that's the principal, times the rate. I'm sorry, 8%. So that's $400 per year in interest. If I divide that by 12, that gives me the monthly interest amount. And then I can figure out how much interest is accrued by the end of the year. If it was issued on June 1st, that gives me June, July, August, September, October, November, and December, 7 months worth of interest. So if I take this monthly amount and multiply it by 7, that gives me the amount of interest that's accrued by the end of the year, $233. Number 29, on May 2nd, Wainwright Company receives $3,000 4-month 10% note from the Fulton Company as a settlement of accounts receivable. What entry will Wainwright Company make when it receives the note on May 2nd? So again, their notes receivable is going to go up $3,000, and their accounts receivable is going to go down $3,000, and that's it. Any other amount that tries to figure in the interest is just not right, because we don't do that when we make the initial entry. Interest comes later after we've earned the interest by having the money lent out over a period of time. Number 30, Butte Company loaned $25,000 to Beavis Company, nice, on June 1st at 12% interest for 3 months. What adjusting entry will Butte Company have to make on June 30th before preparing its financial statements on June 30th? So If the money was lent on June 1st, then 1 month of interest will have accrued by June 30th. So again, we just need to figure out how much that is. So if we take the principal of $25,000 times the rate of 12%, that gives us 1 year's worth of interest on the note. We divide that by 12. That gives us 1 month worth, which is $250. So we'll do an adjusting entry to recognize that we have earned that interest. So we'll have interest receivable of $250 and an interest revenue credited of $250, and that will be our adjusting entry. Now is the moment of truth. We'll grade it and see which ones I missed. This says we got 100%, so even the one that I was not sure about looks like it turned out for us. So that is Chapter 8. Again, I say it every time, but please call me or text me or let me know if I can help you in any way. Have a great week, and good luck on the exam.